All right. Well, good job.
I'm back. Thank you.
Yeah. So now we understand protective puts. We know how that locks in profits. And a couple other things that you can do is you can actually create your synthetic call, which is similar to a protective put. It's actually the exact same thing. I shouldn't say similar.
Yeah, actually the protective put strategy is a synthetic long call.
Right.
You know, the protective put is interesting because it obviously can take advantage of a few things. The put call skew, which we talked about in volatility. If we see that we're in a situation where we would buy a call, suddenly we have another alternative. And if the put is actually priced at a lower volatility than that call, buy the put, buy the stock in a 1-to-1 ratio, and you've recreated that call at a cheaper price than what the call's paying, trading for.
Sure.
The other thing is, too, it's the concept of the protected put. Not so much that you and I would do it, because I know that you don't like buying stock, and I sure as heck don't like wasting money on stock. One of the things you have to understand, though, is that sometimes some of these strategies, it's the concept that's important, because the concept is applicable in other places in other ways. Here, we are protecting an individual stock, but we can actually use this same concept to provide portfolio insurance or portfolio protection via something called dynamic hedging, which, at some point in time we'll get to.
Well, just remember, you could enter the position in the cheaper way. You can exit the position in the more expensive way. A lot of people out there like to own a stock and buy the protective put, when the reality is sometimes you just buy a call. Sometimes it makes more sense because it's less expensive.
It's also less risky.
Right, and it also frees up some cash. If you own a stock and you buy a protective put, you can just buy the call option. It's the same exact risk and same exact reward, only you can do more with the cash that you have. You free up some cash. You can put it in risk-free interest or anything you want.
And
you can buy some toys.
Buy some toys. You never know.
A car.
And whatever you want to buy, we'll get you one.
Okay.
But the thing is that the importance, the importance of that is that this is the strategy that proves that actual buying an option and trading options is safer than buying stock. Because what would you do to protect a stock position, a long stock position? You buy put.
I'd buy the call.
I understand that.
That's what I would do. I'd sell out of the stock immediately.
They might not understand that. But the thing is that if you see that the way we would best protect a long stock position is to buy a put, and you agree with that, then what you have to understand is that you've now, by adding the put to your stock, you've now just created a call. That means the call has to be less risky than the stock itself, because the call is actually the stock plus your put, which is the ideal protection for that long stock position.
Absolutely.
So quit buying stock, start buying calls.
So there's only one thing left to do, I think, at this point.
I think it's time to show them how to find the opportunities to use a protective put. Most
opportune times. Okay, we're going to go over that with some more basic technical analysis, and I'll hop to it.
About time.
All right. Bye-bye. So the best time to use the protective put strategy is after the stock that you own is run up. So basically, you'd buy the stock, and after the up move, you'd buy a put to protect yourself, like insurance. So let's take a quick look at when you might do that. Here's Caterpillar, pretty well-known stock. And you can see that right here we found some support. Now, always remember that when you look at a chart, you want to look at a much bigger picture than the area that you're studying. We're only studying these 3 months, but we want to expand the chart and look at least 6 months back. And when we do that, what we find is old support levels and old resistance levels that might mean something important today. So you can see back in October when the market really collapsed, you can see that we found support right here at this level. And it's no coincidence that this level meant something back in February here. We found some support, and then once that support was broken, it just kind of free fell down to about $21 a share, $22 a share. We could see that right here we had some trouble. Remember, old support becomes new resistance. You could see that we found some trouble getting through this level right here. But once we did that, that's what we call a breakout. That's a meaningful breakout. So that old resistance level, this level used to be a resistance level, becomes the new support level once the stock breaks through the resistance level that you see highlighted in green right there. You could also see, like I told you before, volume is very important to study. You can see that around these levels, the green bars are bigger than the red bars for the most part. That shows that there's institutional accumulation. That means that the stock's moving higher because of the buyers stepping in as opposed to sellers just not willing to sell anymore, and there's a big difference. An old saying goes, volume equals validity. So if there's volume behind a move, that means that the move is valid and more reliable. So you can see that the stock broke out, and that's a good time to buy the stock or take some sort of a bullish position in the stock, because the old resistance level becomes the new support level. So when it breaks out, and it breaks out in some pretty decent volume that you see right here, chances are this is going to act as a support level. You could see that that actually happened. Well, that would be a good time to get bullish on the stock. The protective put, you'd want to buy some insurance after the stock's run up a little bit. So say the stock ran up to about $40 a share, and you think that it might be due for a pullback, because you can see that this is a key level right here also. You see at $40 a share, there was some resistance here, became support, and then there it looks like it's going to become the new resistance level. And you can see down here the RSI sell signal. RSI sell signal is when the RSI goes above this blue line that you see here, which is the 70 line, overbought territory, and then reverses back below it. That's a sell signal. And that's the best time to take your protective put as insurance.
To see how Ron selects options that match Chris's strategy, visit the members section at optionsgps.com.
It's a great explanation of, when you're going to see the type of opportunity, technically, that you can use the protective put strategy for.
Well, thank you for
Well,
that
you're
compliment.
very welcome.
So now the next thing that we're going to talk about is going to be the rolling and the morphing of the protective put strategy. And as we said before, when a stock moves up or down, or when certain things happen or time passes, the variables in the price of options change, and that changes the ideal strategy for the time being. Now, we also said that owning a stock and a put is a synthetic call. So if you think about it, if you own a call and the stock moves up or moves down in the direction that you want it to, well, then you're going to have to roll and morph that call.
That's exactly right. You can't be in the wrong position at the wrong time. We know that nothing lasts forever. Right. So once we're in that position, we know something will change at some point in time. Right. And you've shown, targets like, hey, if the stock gets to here, this specific point or there, hey, this is now what's happening. We have to be able to take that information, understand it, and then make our strategy show that. And that's what we do when we roll and morph.
All right. Well, I think that you should just hop to it, show everybody how it works. It's very important that we make sure that we put ourselves in the ideal situation when these different variables change. So, show us how to take a good situation and turn it into a better situation.
You got it. Now that we know how to locate these type of situations where the protective put is warranted, let's start talking about making the trade, the setup. The first thing we have is, if we haven't already bought the shares, we're going to need to buy shares of stock, and we're going to buy them in 100 share lots. Why 100 share lots? Because the put, an option contract, is worth 100 shares. Then we're going to buy the put, and we're going to buy that put, one put for every 100 shares. So if we bought 500 shares of stock and we need to protect it, we want to buy 5 puts. What we kind of want to do as best as possible, we don't have to be perfect, and I'm not expecting anybody to be perfect with this. We want to try to match our days to expiration of the put with the amount of time that we feel we need to protect ourselves. Remember, we don't want to overbuy insurance, but we also don't want to underbuy insurance. So if we say, hey, I think the next 3 months are going to be kind of rough in the market, let's not buy a 12-month put. Let's buy a 3, 4, or maybe even 5-month put. Try to time the amount of insurance you need with the amount of time you need it for. Let's take a look at an example of the at-the-money protective put. We buy the stock at 60. We buy the 60 put for $4. Remember, our maximum gain is unlimited. Once we get over that break even, we're making dollar for dollar, no matter how high the stock goes, as far as it goes. So we still have plenty of room for capital appreciation. Our break even is simply the stock price plus the put price, which in this case will give us 64. That's our break even. Dollar for dollar above that break even, we are making money. Maximum loss is $4. If the stock finishes right here, and we know that when we buy an option, the last place we want that stock to finish at expiration is right at the strike. If the stock finishes right here at the strike at 60, the 60 put will now be worthless. The $4 we spent will now be 0. Our maximum potential loss is the $4. What if we try an out-of-the-money protective put? Now, this is the one that I kind of recommend, because think about using a stop order. When you buy a stock and you put in a stop order to protect yourself, do you put the stop order right at the same price you just bought the stock? Of course not. You got to leave a little wiggle room. I like trying to say to myself, hey, I know this stock is going to fluctuate. I don't necessarily have to make sure that I only lose a little tiny bit. I only want to lose 20 cents. I understand that the stock needs room. And I also don't want to have to spend a lot of money in my insurance. So what do? I buy something slightly out of the money. I might buy the 55 put, for instance, allowing me to limit my loss, but not get too crazy with trying to limit it to the zero. Maximum gain, again, is unlimited. Once we get over my break even, dollar for dollar, I'm making with the stock on the way up. Where's our break even? Our break even's lower. When we use the out of the money protected put, we're going to see a lower break even. Buy the stock at 60, buy the 55 put at $2. Stock price plus put price is your break even, 62. Maximum loss is $7. How do I come up with $7? 55 minus the $2. And how do I come up with that? What happens if on expiration the stock closes at the exact spot that I don't want it to? Where is that spot? As a buyer, where's that spot? We don't want it closing directly at the strike. That is my point of maximum loss. If the stock closed at 55 at expiration, I would have lost $2 in my put, because the 55 put with the stock at 55 at expiration will be worth $0. I lose $2 there. But don't forget about my stock. I've lost $5 on the stock. Now, for those of you that say, hey, I'm planning on holding the stock for 20 years, then you know what? That $5 loss is no big deal. You're going to have $5 losses, $5 gains, year to year to year. However, if I'm looking at more of a short-term thing, then I have to take into consideration the amount that I could also lose on the stock. This, however, limits my loss to a maximum of $7. If the stock opens tomorrow morning at $13, it doesn't matter. The most I could lose is $7. Here's an example of the in-the-money protected put strategy. Buying the stock at 60 and buying the 65 put for $7. My maximum gain, unlimited. Once I get beyond that break even, regardless of where the break even is, obviously higher in the case of the in-the-money protected put, I'm still making dollar for dollar as high as the stock could go above that break even. Break even, stock price plus option price, 67. Once we're above 67, I'm making dollar for dollar as high as the stock can go. So I still have room for capital appreciation. My maximum loss is $2. Why? Because this is an in-the-money put. If the stock closed right on the strike, directly on the strike, because we said that that's the worst place for the stock to finish when I'm an option buyer. Finish it right here, 65, at expiration. Boom, done, finished. What do I have? I've got a loss in my put, don't I? That 65 put is going to be worth $0. Stock's at 65. That put is worth $0. I've lost $7. However, look at where I bought the stock. Now, buying the stock at 60 with the stock at 65 gives me a $5 profit. Made $5 in the stock, lost $7 from my put, total loss of $2. That is my maximum loss. How do I know it's maximum? Because if the stock closes directly at the strike of my long option, I am at the point of maximum loss. So what are the keys to success when I'm using the protected put strategy? Again, solid fundamental and technical analysis of the stock. If I can make sure that I only use the protective put when I truly need it and not any other time, then I'm not going to be wasting money. And what I mean by wasting money is holding a put for protection that I don't need and watching that extrinsic value decay every day, day to day, month to month, and for as long as I might want to hold that protective put. If I don't need it, I probably shouldn't have it because it will lose money. It'll protect me in the case of something bad, but it's definitely going to lose money while I have it. Don't purchase too much time. Look, most down movements in the stock market are not real long. Even the longest of longest bear markets only going to be a couple years. We don't have to buy too much time. We don't want to buy too little, but we definitely don't want to buy too much. We want to try to be as efficient in terms of finding out, to the best of our knowledge, through technical and fundamental analysis, how long the stock could be at risk. And only buy the option to cover that time. Hey, if that time extends, we could always then reinitiate a new protected put strategy. Don't buy too much time. Don't purchase too little time. The thing is that when you buy too much time, once you realize you've bought too much, it's too late. If you buy too little, you can always extend it. So you're better off taking too little time than too much time. Be prepared to lose value on the put. So many people don't understand that this is an insurance policy. You want to lose on the put. You want that put to go to zero, because if that put goes to zero, that means your portfolio is still intact and maybe even better off than where it started. So you should be happy when you lose. When you see that put go to zero, you should be happy. Think of it like I had said before. It's like a life insurance policy. When 20 years are up and they tell you that that policy is expired and you're still alive to hear them say that, everything's okay. And always remember, you are still bullish here. This is not a bearish strategy. This is a cautious strategy. If you're really that sure that the stock is definitely going to go down, sell it. Don't get cutesy and try to be cautious. This is a strategy for being cautious. You're still bullish here. You still expect the stock to go up. You're just worried or concerned about something that might be coming up. You're still bullish. You've got to remember that. You're not bearish. You're bullish. If you were bearish, this is not the strategy. We would just sell out the stock. We would do something else. This is for protection of a bullish position. Now we want to talk about trading the protective put. What if the stock goes up? Well, if the stock goes up, we can roll the put with the stock. There's only one problem. It's a debit trade. See, when we were talking about stock replacement and we were rolling our call and we were rolling our put, we were rolling in a direction where the trade itself, selling our current strike and buying the next strike, was a credit trade. We were bringing money in doing that. Here, in this strategy, if the stock goes up and you want to keep maintaining your protection, you're going to have to roll the put up. Stock replacement, remember we were rolling the put down? Here we have to roll it up. That means it's a debit trade. That means as you roll, you're spending money to roll. You're paying money to lock in money. Obviously, a bigger amount is being locked in than you're spending, or else it's not worth it. But the fact is that you can roll this put. You can maintain your position. The only difference is you got to pay to do it. What about a morph? Should we change the position? Well, wait a second. Didn't we just get done saying that we are still bullish here? And if we're still bullish, don't we benefit from the stock going up? Obviously, if the stock is going up and we're in this position, we're doing pretty well. There's nothing to change. The stock is doing what we wanted it to do. We're still bullish in the position. Again, there's no reason to close it. There's no reason at all to close it. The position is making money. If the stock is going up and we're in a protected put position, we are profiting. There's no reason to change it. There's no reason to close it. We just have to figure out whether or not we want to roll it and pay the debit to do so. So let's take a look at that roll. Here we are in our protected put. Long the stock, long the put. If the stock were to trade up, we would have to roll our put up with it. The problem here is that as we roll the put up, instead of rolling down and getting the credit, we're rolling up and paying a debit. Each time we roll up, we're moving from a cheaper option to a more expensive option because we're rolling into the in-the-money options. So let's take a look at that roll. We have the 65 put. The stock is run up. We want to move our protection up. What do? We sell out our 65 and we buy the 70. Problem here is our 65 will be trading at a lower dollar value than the 70. We're going to be putting more money out than we're bringing in, hence the debit. So do understand that if you're going to roll like this and constantly move your put up, you're going to have to pay for it. It's kind of like insurance. You buy life insurance when you graduate college, you get a full-time job, you only need a little insurance. But suddenly, next thing you know, you're getting married. Oh, got to knock the insurance up. In order to go from a $250,000 policy to a $500,000 policy, you're going to have to start paying more money. Same idea here. We want to move our protection up. We've got to pay money to do it. Now all of a sudden you got kids. Time to move up to $1 million. What are we going to do? We've got to pay to do that. You want to move your protection up, you've got to pay to do it. What if the stock goes down? What happens now? Well, this is why we put on the protected put position, because we were a little nervous about the situation. Are there any rolls? No, there's not. You might think, hey, as the stock goes down, let's just roll our put down. The problem is that, remember, by owning this put, you are not decreasing your loss. You're limiting your loss. It's not as though you're saying you've eliminated it and say, okay, now I'm in a protected put, I have no potential loss. You do have a potential loss. It's just limited. If you roll that put down as the stock goes down, you are constantly going to be putting yourself into a position where you can lose a little more. This put is in a position to have a specific amount of loss and then no more. You can't roll it down because then you're going to put it in a new position to lose more. You have to leave the put where it is when you bought it. So when the stock goes down, you have your protection, but you have to keep that protection stable. If you don't and you roll it down, you're opening yourself up to more loss. Well, we can do something else, though. Let's say the stock is going down and we say, hey, wow, stock is heading down. Thank God I bought my protective put. And we look at it again and say, my gosh, the stock's really getting hit. Stock's now going down hard. We have something we can do. We can actually make a move here. We can morph this position. Instead of being a protective put position, where we're protecting a long stock position with a long put, we can turn around and get offensive. Say if the stock gets down to a support level and breaks support. Now we say, my God, this thing's breaking down. What do? We can change our protective put strategy into a stock replacement put. The put, which was purchased to be defensive and protective, can now be used as an offensive weapon. What about closing it out? Hey, you know what? We've got our protection. We're protected. We're done. We can close this out. How do we do it? Well, if we're already long stock and long put, we're already 2 of the 3 steps toward a conversion. Long stock, long put equals what? Equals long synthetic call. Synthetically, we're long a call here. All we need to do is sell out the real call to shut this position down in one trade. When we sell the real call, we put ourselves into a conversion. And the conversion, as you know, is an arbitrage, a position with no position. Let's take a look at that roll that we were talking about here. that morph, where there's no roll here. Let's take a look at the morph. So here we are in our protected put. This put was purchased to protect the stock. And remember, I said that the real monster here in the position is the stock. That's the money maker. But if the stock starts going down, and we recognize that, and we say, hey, this thing's breaking support here, it could go down big, we simply sell the stock out. See the stock disappeared? Sell it out. Now that I've gotten rid of the stock, what am I left with? Simply a put. Suddenly the stock is falling out of bed, and I am just simply long a put. The stock was the real heavy in the position when it was the protective put. It was what was making me money as the stock went up. But now that is gone. The real heavy is now all that's left, which is the long put, which is going to be making money as the stock goes down. So if the thing turns on me, dump out your stock and ride your put in stock replacement put fashion. Simple as that. Finally, the last thing we could do is we can always just close the position down. As we said, long stock, long put, we know that that is like being long a synthetic call. If that's true, we sell the real call corresponding to the long put. Sell the real call, and where are we? We're in a conversion. The trade is locked down and done. No position, no risk, it's over. Sometimes you might not be fully confident that what you're seeing in terms of the trading down of the stock is actually a lasting thing. So you might not want to morph it and be aggressive and turn it into a put. You might just say, I want to close it down. There's the easiest way to close it down. What if the stock stays still? Well, we can roll out to buy more time. Again, the problem is that if you keep doing that over a long period of time, the premiums that you're buying are going to eat you alive. Remember, the put we're buying for protection, it's going to decay. So if we don't use it, we're going to lose money here. It's like that insurance policy. Every time that you go to renew your insurance policy, the money you spent on the old one is considered wasted because you didn't die. Same thing here. If we're going to try to use the put over a long period of time for protection, we're going to be putting out a heck of a lot of money. We're going to experience a heck of a lot of decay. And that means the stock doesn't just have to outperform, it's going to have to radically outperform to make up for all those lost premiums. That's why I'd said before, timing is essential here. We could roll out once, maybe twice, but we don't want to roll out often. What about a morph? Well, if we suddenly think that we need a longer time frame, we need a longer piece of insurance, we can always change it into the collar. The collar is a position that is really defensive in nature. What happens is in the way that we don't want to hold this protective put for a long time because of all the premiums that are going out, the collar adds a short call into the mix. That short call is premium coming in. That premium that's coming in is offsetting the premium we're putting out to own the put. So what happens is that if we need longer term protection, don't use the protected put, use the collar. It won't cost nearly as much, and you might even be able to do it for a credit. Closing, do you want to stay in the position or do you want to close it out? Well, that's a tough decision. If you're expecting that downward movement that hasn't come, you have two things to think about. One, am I wrong? Two, maybe I'm right, but just a little early. That's why you have to consider that roll, and that's why you have to consider the collar. We could always close it out. But the fact of the matter is, if you felt there was a big reason to have protection, and you haven't seen that reason come to fruition, it might not come to fruition. We might not want to close the position out. We might be too early. I've been early on a lot of things, waiting on stuff, wasted more money than I made once I was right with waiting to be right. You've got to be careful. I probably wouldn't want to close the position until I had a good reason to say to myself, I don't think I need the protection anymore. If the stock is staying still and things are still equal and I'm still expecting some type of trouble in the stock or in the market in general coming up, then I stay with the position. I don't close out. If I only need it for a couple months and I was a little short on time, I could always roll out once or twice. If we're talking about needing it for a longer period of time, we've got to move into the collar. Here's the collar right there. All we did was add the sale of an out-of-the-money call, hopefully equidistant out of the money as the put is out of the money. What happens is this put that is protecting this stock is costing us money every month, month after month after month. Well, like I said, that gets very expensive, sometimes prohibitive. What can we do? Well, we've got premium going out, but nothing coming in. Let's change that. Let's give up some of our unlimited upside potential by selling an out-of-the-money call. The money that we bring in from the sale of the call helps offset the amount of money we have to spend on the put. Suddenly, I get to own this protective put, in essence, for free, because my short call is financing my long put. Now, I've given up my unlimited upside potential. But if I'm really sure, or I'm starting to get really scared about the prospects of what the market or what this stock might do, I might be willing to give up my unlimited upside to be able to finance this protection over a longer period of time, keeping my portfolio safe and sound in case something happens in the future. So that's the protective put. Is it a great strategy to use? Well, when you think about it, seeing that it's synthetically the same thing as a long call, you probably could have avoided ever using the protective put by not buying the stock and then buying the put. You could have just as easily bought the call. But for those of you that have long stock positions and are going to always keep long stock positions in your portfolio, there's nothing better to protect your nest egg than the protective put strategy.
Great job, Ron. Very good. Okay, now that we understand protective puts, we're going to move on to synthetic puts. Before we do synthetic puts, what are we going to do? OptionsGPS.com. Go to the community. Ask questions, answer questions, hang out with your pals. Get to know the material a little bit more, then take the quiz. After you take the quiz, first of all, make sure you pass the quiz. After you take the quiz, then I'll meet you on the next DVD, which is synthetic puts.
Well, now that we turn our attention to Chris's example where he found us the opportunity, we're now got to apply the strategy. So what we did was we decided to take a screenshot here of the actual option chain with the actual option prices from the Thinkorswim platform, and we are going to now look at what you would have actually seen the moment that Chris identified the opportunity for you. So what we're looking at is the protective put, and Chris selected Caterpillar, CAT. As you can see over here, the stock is trading at $38.26. Now, you might notice that the last trade up here is a little different. The reason that last trade is a little different is Caterpillar obviously was trading a little after the close. Now, let's take a look at our options chain. When we're in the protective put strategy, the first thing that we know we need to do is to buy the stock. So we probably own the stock. We've owned it for a while. The stock has run up, and now we're at a point where we think it may go a little further, but we're now starting to get nervous about our downside. So we're going to take a look at some puts here. Now, over here on this side, we have our puts, and there you can see the strikes. There's your May 40 put, 39 put, 38 put, 37 put, 36 put, so on and so forth. And actually, when Chris saw this movement that he identified, it was May 6th. So May is our front month. We don't really need to get too aggressive with the purchase of our protective put. Think of your protective put for all you stock traders is kind of like your no-fail stop order. This is a stop order that will work no matter what happens. You don't get burned on gaps here. Stop orders, you can get burned on gaps, but not when you buy a protective put. So what we're going to look for is a put that's maybe a couple strikes out of the money. And the reason I'm saying a couple is, as you see, the strikes are $1 apart here. So that gives us a little flexibility into customization. So as we look at it, I'd look at maybe these May 38 puts right here that are 67 cent bid, 69 cent offer. They have a 28 delta. They have obviously a positive gamma. They're going to decay at about 6 cents a day. They have a very small Vega component. So Vega, volatility movements aren't going to hurt or help. And an implied volatility of about 56. Now what we're going to do is I'm going to buy one of those May 38 puts. I'm going to buy one for every 100 shares of stock I own. So what does that do for me? As the stock starts trading down, say if the stock collapses, I am going to have the right to sell that stock out to someone else at $38 a share, and it cost me 69 cents to do it. So for roughly 70 cents, I have guaranteed that this stock that is trading at 40, I'm going to at least get $38 back for it. It has protected me, and it only cost me 70 cents to do that. And when we do that, the new position we've created synthetically is the same thing as long the corresponding call. So when you think about it, after you put your put on and have created that protected put strategy, come over and take a look at the corresponding option, because now your position is actually going to function the exact same way, perform to a penny of this corresponding call.
Hi, this is Ron Ianieri of Tycoon U, and I'd like to welcome you to an introduction to dynamic hedging. I think this is a very appropriate topic right about now because many of you are sitting on a portfolio that had been damaged probably pretty dramatically once, and now we've had a recovery with a potential new damaging session on the way. Many people have already stated that this recovery probably is not going to be a lasting one, at least in the market, and we should look for some type of pullback. And we've probably been around long enough to see enough of these pullbacks in the markets to where you're probably tired of losing money during these pullbacks and want to know, what can I do to protect my portfolio? Dynamic hedging is what you can do. So let's go over briefly what dynamic hedging is. Well, first off, we have to take a look at what hedging is in the first place. Hedging is simply a process where the investor is going to protect their portfolio from adverse movements. And this normally involves making a counter trade that actually is opposite of what our real position is. Now, many people think that hedging is some type of form of liquidation. We're not liquidating our positions here. That's the idea. We don't want to liquidate our positions. We just want to protect them. And protection is the name of the game anymore. And it's so tough to make money only to lose it again, only to make it again, only to lose it again. That vicious circle gets us nowhere. What we want to start doing is making money, protecting it, making some more money, and protecting that. So that way, every time we have a downturn in the market, we don't give up all we just made only to start from the beginning again. So hedging is not liquidating. We're going to keep our positions. We're simply going to protect them. So what can be hedged? Well, first off, any influencing variable can be hedged for its risk. That means if you have a stock portfolio, you can protect yourself from any type of risk that would affect the stock portfolio. Obviously, adverse movements of stock direction would be something you can hedge. And you can hedge that by something we call delta, one of the Greeks. Volatility. Movements in volatility can also affect our portfolio. And movements in volatility can be hedged by Vega, another one of the Greeks. And finally, the last real influencing thing is time decay. And time decay risk can be hedged by theta, one of our other Greeks. Now, there is a conventional hedging. Simply hedging against your adverse stock movement, which means that, hey, I own IBM and I think IBM's going to go down, but I don't want to dump out the position because I'm not sure it's going to go down, and I sure as heck don't want to sell it out and have it run up on me. I just want to protect my downside. I want to only lose a little bit if it goes down. So what can I do? I can calculate the delta of my IBM stock position, each share consisting of one delta, and then I could go out and buy puts on IBM. Enough puts that would give me the right to sell my shares out at a specific price by a specific time if during that time frame the stock does dip and drop further than I would have been happy with. So what I'd be doing here is I'd obtain an equal amount of contra deltas through other related security, meaning options. And I can actually customize this a bit. I can calculate the degree and level of protection that I specifically want at a specific price level. If I want to be very hedged, I could buy more puts or puts with a higher negative delta. If I wanted to have less hedge because I'm pretty sure we're going up, but I'm a little bit worried, I can buy a less amount of protection. So in conventional hedging, we're looking at protecting in a single position using options. Puts, of course, for a long stock position, and for some of you bears out there, calls to protect against a short stock position. And we can customize this protection the way we want it at any given time. Now, if we're going to look at hedging against adverse movements in implied volatility, we would use something called Vega. And we could actually, if you have an option position, or better yet, a portfolio of option positions, we can actually calculate the Vega of our position and then obtain an equal amount of contra Vegas through other options to protect against a potential movement in implied volatility that could hurt us. Again, we can calculate the degree and level of that. We could also do this for theta, the passage of time. For those of you that are already trading options, you might have many options in your portfolio right now. Maybe some solely designed to just replace your stock position. Well, those options will have a little time decay because they'll have a little extrinsic value, which will be affected by the passage of time. What can we do? We can calculate how much theta or time decay we have, and we can actually calculate the degree and level of protection we want to have, and thereby hedging our position. So not only can stock traders use options to hedge their position, but option traders can use other options to hedge their option positions. Well, hedging an individual position is easy. And for a lot of people, you might only have 1, 2, or 3 stocks that you own. You can actually very simply hedge those stocks individually. I own IBM, I own Dell Computer, and I own Google. Well, I'm going to hedge my IBM position with IBM options, my Dell position with Dell options, and my Google position with Google options. Only problem is that what happens if I have a portfolio that's got not 3, but 73 stocks in it? Well, the thing about hedging individual positions is if you had already been in that option position, many option strategies, unlike stock positions, many option strategies have built-in hedges. Spreads are already naturally hedged due to being long one option against short another. Long options, simple long options, already come with their own built-in delta hedge because we know that we can only lose the amount of money we spend in the option. So if we can control the amount of money we spend in the option, then we control our risk. So individual positions are not really a hedging concern unless they are stocks. And then, even though those individual stock positions are a hedging concern, we can very easily turn to options on that specific stock to hedge ourselves. No problem. But the problem is, what if you have multiple positions? Whether you have 73 option positions or 73 stock positions, trying to hedge each and every one of them individually would be a nightmare. By the time that the market started going down and you started hedging every single one of your 73 positions, the market will have already crashed by the time you're done. It would have been a waste. That's where portfolio hedging comes in. See, when you have a big portfolio, it's super hard to hedge every position individually. Number one, it's a time. It would take too long. But number two, cost. It would be very expensive. And quite often, one of the problems is that you improperly assume that all stocks will react similarly. You're buying the same amount of puts to protect the same size IBM position as you are buying puts to protect the same size RIM position. Well, guess what? IBM and RIM are going to act differently. So different positions of individual stocks will require a different amount of hedge. So it makes it a lot more difficult. It takes a lot more time to calculate, okay, what kind of stock is this? How much protection do I need? At what level? That's going to be different from this other stock, which you then have to calculate that one. And that's different from this other stock. And you got to go 73 of them. You'd go out of your mind. You'd waste too much time and too much money. So what do we need to do? We need to dynamically hedge. And dynamic hedging, the real key to it is understanding the interrelationships in the market. See, stocks move in correlation with each other. Some stocks move non-correlated with each other. But the fact is that the correlations in the markets, the relationships from stock to stock, from stock to index, can be calculated, and because they're calculated, they can be traded. And that's going to be the key concept behind dynamic hedging. Now, there's another relationship between stock to stock. And as I said, I've already mentioned it. It's stock to the overall market in general. You see, a stock like IBM that's in the Dow Jones 30 Industrials, that stock is related to the other 29 stocks in that index mathematically. So we could get a good feel for how our IBM position is going to hold up if the market itself trades down. Because IBM is probably very heavily correlated to the Dow itself. There's a mathematical relationship that exists there. So even if IBM isn't having a bad day in and of itself, if the Dow's having a bad day, the relationships, the mathematical relationships of the 30 stocks in the Dow, including IBM, will move IBM down. It has a correlation. Now, some stocks move in a very, very highly correlated manner. We call that a positive correlation. They move very similarly to the market. Some stocks move in a negative correlation. They don't really do what the market's doing. They kind of do their own thing. The market goes down, but the stock's up. We call that a negative correlation. But in the same manner that we can correlate an individual stock to an entire index, we can actually correlate your portfolio to an index. And the secret behind the ability to quantify that relationship is a statistical reference known as beta. Beta tells us and measures, quantifies for us the movement of an individual stock in relationship to the movement of the market. So that means we could take the beta of the 73 different stocks in your portfolio and create one whole entire beta for your entire portfolio. We don't just measure how much your one stock will move in correlation to a movement in the S&P. We can actually take the whole portfolio and calculate a beta for that and see how your whole entire portfolio moves in relationship to the S&P or the Dow or the NASDAQ or any of those different little ETFs if you're heavily situated in one single industry. We can actually bring forth an equilibrium through beta, saying that when the market is down this much, your portfolio will be down this much. And once we have that ratio, then we can hedge your entire portfolio using the index. So the beautiful thing is, any portfolio can be beta weighted, mostly for delta, because most of you are going to protect, most of you are stock traders, you're going to protect against the stock movement. That's what delta measures. But if you're an option trader, you could also beta weight your portfolio for Vega or even for Theta. So a portfolio, the entire portfolio, can be beta weighted against any security that's representative of the broader market or industry. So we not only can beta weight against the S&P, because most of you people out there will probably have, a portfolio that's got a lot of different stocks and a lot of different industries, and you can very simply beta weight that portfolio to a broader market index like the S&P 500. Some of you might only trade one industry. Well, we can use an ETF. We can beta weight against the ETF. And once we've done that, we now have our hedge. Now, you might say, hey, Ron, that sounds like a heck of a lot of math. That's insane. And, you might even understand what I'm saying. If I know that if the Dow is down 1%, my portfolio is down 1.5%, I could then go into the Dow through the diamonds, an ETF, hedge the diamonds to protect me down 1%. And if that 1%, that protection down 1% is equivalent, beta weighted, to my portfolio being down 1.5%, then by hedging against the 1% movement of the Dow, I've protected myself a 1.5% decrease in the portfolio I have. That is the key here. That's all we're doing. We're saying, look, your portfolio lost $10,000 with the Dow down 500 points. So what do? We figure out how to hedge ourselves in the Dow down 500 points, and we've now hedged ourselves in our portfolio. So all I have to do is figure out the math. Wow, that's the difficult part, right? Wrong. Why? Because brokers, like the one I recommend, Thinkorswim, have beta weighting systems. Now, I'm not sure if everybody else does. I know Thinkorswim does because I use it. All you have to do is when you have your portfolio entered into your platform, your electronic platform on your broker's platform, all you have to do is you automatically beta weight it to whatever index you want to beta weight against. It's very easy. If you know that you're heavier in Dow stocks, you could just say, hey, I'm going to use the diamonds, an ETF, because my portfolio is already more closely aligned with that, so the betas will be close. It'll be better and easier for me. If I have a broader one, maybe I use the S&P 500. So I just have to select which index to use based upon the types of stocks in my portfolio. And all I have to do is in the platform of Thinkorswim, select what I want to beta weight my portfolio against. Bang, it gives me the number. Just like that. And from there, I know how many puts to purchase in the index to protect my portfolio if the index is down so much. And this way, I use what's called these beta adjusted deltas. For most of you just trading stock, or Vegas from some of you option traders out there that want to hedge your Vega risk. And that's going to tell you how many options to buy or sell to protect your position. Normally, we're talking about protecting ourselves from a downward directional stock move. Most of us are going to be put buyers. We're going to see how many puts we need to buy or how many deltas worth, go into our platform, select that ETF that we're basically beta weighted against, know how many deltas we need to buy in puts, pick our put strike that we want to use, normally a put in the 30 to 40 delta range. Remember, this is protection, so we're not saying to ourselves we don't want to lose anything. I mean, we know that we have a tolerance, we have the ability to lose some, we just don't want to lose a lot. So we're going to go to that slightly out of the money put, and we're going to buy the amount of deltas in that put that we've been told to by our beta weighter. And that's how we dynamically hedge. This way, you're using one single option to hedge your entire portfolio instead of going through 73 individual stocks, one by one by one. Insane. Let's hedge not the individual stocks. Let's hedge the entire portfolio. And the way we do that, the way the professionals do it, is called dynamic hedging. And we use betas to set up correlation between our portfolio and a selected index. And once we've done that, all we got to do now is buy our puts and sleep comfortably.